Thank you. Stephen Kinnock.
Thank you very much. And good morning. Isn't the fundamental challenge with this process is the constant attempt to create a bespoke deal, to create something new in a situation where there's a tremendous amount of time pressure and a lot of political goodwill has been burned. In that context, have your respective industries looked at the European Economic Area as a model for Brexit, and particularly given the fact that it's a well-known, well-established agreement that industries and governments could slot into? I'd be very interested in hearing from the panel on your views on an EEA-based Brexit as potentially solving so many of the challenges that you've raised today. Perhaps starting with Mr. Evans.
Yeah, thank you. I mean, we have looked at that, and I think we are not fans of the arrangement. I think I would agree with your starting point that given the situation you describe, it's imperative to try and find workable solutions. And in fact, that's why many parts of the insurance market have gone ahead and set up subsidiaries in the European Union to be ready by next year to enable them to carry on transacting business in the EU, and they will be regulated in that manner. And I think that's been a very notable characteristic of the insurance market's response to the Brexit referendum. So they've sort of done that already if they need to absolutely be sure they can write a new European business next year. And that, I think, then colours our view to the sort of merits or otherwise of an EEA approach. Because if the firms that absolutely need a European licence to operate have gone ahead and set up a subsidiary, and then the other firms are largely domestic players, then the big disadvantage of being in the EEA is to be a rule taker, both for your domestic business, but also when you have already sort of signed up to EU rules with the subsidiary that you sort of set up. And certainly our experience with talking to our Norwegian counterparts, with whom we have a very close relationship, is that they've said to us, well, don't become us. It would be their view is that for a market the size of ours, over 20% of the EU insurance market, it would be entirely unsuitable to be in the EEA model and be a rule taker, and to not have any influence on how those rules are made. And particularly, I would draw a distinction here for the long-term savings market rather than the general insurance market. For the long-term savings market, rules in the European Union, and we saw this with the development of Solvency II, are driven by the very different tax and welfare systems that operate within the member states that inevitably affect how their pensions and long-term savings markets work. So for us to end up in the long-term savings market being subject to a set of rules, whether on Solvency II or any other directives, that were driven by the welfare and tax systems of the member states, would potentially be very, very damaging for the UK, particularly for the ability to write annuities, which are a feature almost unique in Europe, the UK market, and which Solvency II, which we had to fight very long and hard to get Solvency II to recognise when we were in the room. So we would be very, very fearful, I think, that being out of the room would see us disadvantaged on that, particularly given there is a big review of Solvency II happening in 2020 when the directive could end up being rewritten.
Other colleagues?
Well, I would agree with Hugh. The consensus around EEA from the sector that we hear is that, first of all, the question of rule-taking wouldn't be appropriate for a sector the size that we house here in the UK, and indeed the amount of risk that we take that we need to manage here in the UK because of having that sector here. So rule-taking wouldn't be appropriate, and it wouldn't give the sector the access that it needs. On top of that, of course, it doesn't...
Although it includes passporting.
Yeah,
so you would have passporting if you're in the EEA?
Well, we'd still be a rule taker, which wouldn't be appropriate for us. We wouldn't be able to develop in the way that we need to. We wouldn't be able to control risk in the way that we'd need to.
To be honest, I look at the EEA longingly and think that would be fantastic. Being a rule taker, okay, that has issues, but as I mentioned before, we are so in excess of EU minimum standards that, whilst not perfect, I think we could live with that if that gave us access to EU markets. But failing that, I mean, as I've said, we don't really desire more flexibility at the moment. So I wonder if there is room for discussing some sort of carve out for audio-visual in terms of mutual recognition. And then we end up going down the list to enhanced equivalence. But can I just mention very quickly something that, in response to Mr. Whittingdale, I mentioned about which countries would require you to have that significant presence, because so you may get, we've had a chain of different embassies coming to the UK to woo international broadcasters, and sure, some of them may say, look, we'll only be pursuing very minimum requirements for you to be based here. The problem will come from a third-party country then crying foul and saying that's not on, especially if they've got a lot of channels moving over there. Just wanted to clarify that.
Sorry, can I? Are we going to go back to John or?
I just wanted to clarify. So you're suggesting that a third country would apply to the ECJ that a regulator's recognition was illegal because there wasn't sufficient presence for them to grant a license?
To the Commission.
To the Commission.
Yeah.
Okay.
Thanks. Mr. Darrington on the EEA.
So we haven't taken the approach particularly looking specifically at models, because ultimately we think that's broadly a political decision. What we have done is looked at where models do not provide enough for the sector, which is why the kind of the association agreement seems, approach that the white paper takes seems to be a potential landing zone. For us, a free trade agreement model, a CETA+++, as it were, we don't see it as being able to provide in any way the types of regulatory support we need. Services are thoroughly undeveloped, even within CETA. So we move past that, and then you are into association agreement, EEA type territory. We haven't particularly made the distinction between the two. There may be areas where, if government wishes to express them, where there may be some benefits for flexibility. We haven't, as I say, been able to identify them ourselves, not least because of our understanding of domestic approach to some of these regulatory areas where UK government is in lockstep with the EU. Now, if there's a change in that, then an association agreement potentially allows you to create carve-outs in a way that EEA doesn't. It's a little bit difficult to know fundamentally what the difference is. For us, the big as it were, Rubicon to be crossed is between a standalone free trade agreement and something which is not quite full third country status, which allows you then to do things like wrap around for data protection, so that the ICO has a continued presence, access to one-stop shop, etc. And the association agreement seems to give us that. You get the same with the EA.
Thanks. So just going back to this rule taker issue, perhaps to Mr. Evans and to Ms. McGuinness. Given that you've all made it absolutely clear that highly integrated trade in services with the European Union is vital for the industries that you represent, isn't it therefore inevitable that we will be a rule taker? It's not possible to export services into a market without accepting the rules of the market that you're exporting into. So, with that in mind, would you rather have equivalence, which is what seems to be on the table from the European Union, or would you rather have the EEA?
I think it's partly a question of timing. I think if Parliament had reached the view 2 years ago that there was a consensus around going after an EEA model, then I think the judgment would have been more balanced, because many of my members who have spent the last 2 years setting up subsidiaries in Belgium, Luxembourg and Dublin to get market access to enable them to carry on running their European business, and indeed Lloyd's of London, who've had to do the same in Brussels, would have not have had to have done so, because the EEA model would provide market access. That sort of horse has bolted. They've spent the last 2 years, they've done it, they've got the market access they need to carry their businesses running. For those of my members who've then got UK businesses left, for them it's the worst of all worlds, the idea that having spent 2 years setting up a subsidiary in, say, Luxembourg, the UK entity is then going to be regulated out of Brussels through rules that they have no say over. They accept it for the business that's happening in the EU, but for them, as for my members who are entirely domestically based, the prospects of being regulated out of the EU with no say on the rules is a problem. And I think particularly for insurance and long-term savings, because unlike banking, our regulatory standards are not internationalised, they're not globalised. The vast majority of regulation for insurance and long-term savings is done through the EU. There isn't the equivalent of the Basel Accords that you have in banking, which set international global standards, which are largely then mirrored in EU regulation. For insurance and long-term savings, Brussels is where it's at and where it is largely done. So for us, it is much more material to be in a position where we have to take those rules. Notwithstanding all that, you're right to say that we have to now look constructively at how to make an equivalence model work. We're at the beginning of that discussion, that negotiation. It's an ambitious ask. We have to make sure that there are arrangements in place, for example, particularly around reinsurance, so that Lloyd's of London and the big sort of large wholesale GI businesses can operate from day one, and we have to make that work.
Thank you. Ms. McGuinness, just and sort of specifically on this point of, given that the EEA delivers passporting, but you would still rather have equivalence than EEA against that backdrop?
I think I go back to the point about rule taking and rule making and the need for us to retain autonomy. I have to say I think there will be a great degree of alignment between at least the regulatory outcomes that we face, that the sector faces here, that it faces within the EU. Alignment for two reasons. First, the access point that you make, that the EU, for the businesses that want to work in their markets, will expect their regulatory outcomes to be met, but also because actually being well regulated is part of the USP of the City of London, and good regulation which complies with global standards is something that we'll continue to want to comply with. What Hugh has just illustrated, though, is how there are differences even within one sector on how they view regulation, depending on how their business is structured and where they're focused. And it's important to note that we've been really influential in shaping EU regulation as it's developed over the years. And if we're outside the room, it may very well move in a different direction that we're not comfortable with.
But that's inevitably going to happen on the 29th of March anyway, because one thing we know with Brexit is we will leave the political institutions. So given that we know that that's going to happen, given that we know we will not be in the room from the 1st of April, your view remains, though, that you think equivalence is preferable to passporting?
Well, and certainly not equivalence in its present form. I think what we need is to seek the greatest possible mutual market access, as I say, for consumers and businesses here, but also within the EU. It's a bit difficult to pick between one and the other, especially when we don't know exactly how equivalence will be enhanced as we go forward with negotiations. But as I say, the bottom line needs to be, I suggest, the greatest possible mutual market access to enable global markets to carry on serving customers across borders.
Thank you.
Can I very quickly make
Yes.
one point on that, which is, for us, a key issue in this is the extraterritoriality of some EU regulations as they apply to digital. We already have data protection law, we're going to have e-privacy, which will likely come in after we've left. For us, on those things, it is far better to be, to have some level of regulatory influence, even if that's observer status, because we will have to comply with them anyway. And so, for our members, including, for example, our American or Japanese or wherever members who invest a huge amount of money in the UK, they do so on the basis of the UK being a strong domestic market, yes, but being able to serve the European market and the UK being able to continue to have some regulatory influence over the things which will apply to them.
So something like membership of the EEA Joint Committee and observer status on EU agencies that comes with EEA membership would probably work in, it's damage limitation.
Broadly speaking, yes. I mean, obviously the white paper talks about, for goods, some kind of observer status on some of the committees and agencies. It's not entirely fleshed out exactly what that means. I think there needs to be more detail on that, but you could see the model in the white paper being able to supply that. It's just a question of ambition.